Imagine this scenario. You're slowly waking up from an afternoon nap in your hammock by the beach, while a cool ocean breeze carrying some mist is sweeping past you. You reach over and grab your phone, noticing you missed a couple messages while you were asleep. As you reply to your friend's texts asking you to hang out, you realize you forgot to tell her you were on vacation in San Diego. However, you also decide now is the time to reveal to her that you're planning to move to California in the coming months. She leaves you on red. A couple hours pass before that friend, who is a professional accountant, calls you. Her voice, though timid, has an air of excitement lining it.
Listen,
She says,
I think this next step will be eye-opening for you, but you might want to read up on California's property taxes before making such a drastic leap. Leave no stones unturned, you know?
Hello everyone, my name is Andrew Underdown, representing Group 7 from Professor Hurley's Multi-Jurisdictional tax class. Myself, Elaine Chen, and Ryan Sullivan chose to study California's tax laws so we can provide you with information about their system. Specifically, we would like to expand on California's property tax for the purposes of this video. Moving to a new city, let alone a new state, can be intimidating for a plethora of reasons. But what if that intimidation was something you could easily conquer through simple research alone? Today, we would like to present our findings on the intricacies of California's property tax laws to provide you with some insight on the Golden State. Now, let's get started. California's taxable property consists of two major types, real property and personal property. I'm sure you're familiar with these concepts, but it's still important to understand how each state defines them. Let's start with real property, as it's a bit more complicated. Section 104 of California's tax code defines real property as the possession of, claim to, ownership of, or right to possession of land. They further include more specific resources, like mines, minerals, quarries, and standing timber, whether or not it belongs to the owner of the land. Finally, more common objects, such as buildings and fences that are affixed to the land, also comprise real property. Because real property can stretch across more than one county, California chose a simple apportionment method that taxes real property for the portion residing in its appropriate district. Simple, right? Oddly enough, unless given express authority from California's state constitution, exemptions from real property cannot be provided. An example of an authorized exemption is low-value property. If the real property has a property value that is so low that it is deemed not cost-effective to pursue certain assessments, the property will be exempt from taxation. So, what exactly qualifies as so low that they don't even want to bother with collecting tax? Without getting too into the weeds, the value of the property cannot exceed $10,000. Now that we have a basic understanding of real property, let's take a look at the other major type of property. Personal property has a much more straightforward definition. If it's not real property, then it's personal property. Similar to real property, personal property is taxable in the location it permanently resides. However, unlike real property, the California legislature has unlimited authority to provide any kind of exemption related to personal property, even if it is not listed in California's state constitution. The law further breaks down personal property into two types, tangible and intangible. Tangible personal property is property that can be experienced by our senses. This means we can feel it, we can see it, we can even taste it if that suits your fancy. It consists of items like machinery, equipment, office furniture, and so on. However, there are types of tangible personal property that are not taxable in California. Household goods and inventories used in the ordinary course of business are a couple common examples. A less common example are non-commercial boats worth no more than $400. The beauty of tax is these seemingly obscure rules that make each district stand out. It's like finding a diamond in the rough when you stumble upon one, but I digress. Intangible personal property, though not officially defined, consists of items like stocks and bonds, mortgages, copyrights, and, yet another diamond in the rough, liquor licenses. Intangibles are rather simple to deal with, as they don't require filing because they're exempt from taxation. We've now covered personal property and its two components, so let's take a look at our final topic. On June 6, 1978, California voters approved Proposition 13, which revalued the property tax to the values established in 1976, just 2 years prior. This proposition also limited the tax rate to 1% of the property's 1976 value, plus an up to 2% increase of your home's assessed value to account for inflation, and would remain as such unless one of two events occurred. The first event necessary to reassess the tax rate is a change in ownership. Let's say after moving to California, you decided to purchase a home rather than rent. Your tax rate would still be 1%, but the value of your home on the date of purchase would define exactly how much that 1% really is. If your house is assessed to be $100,000, then your tax would be $1,000 for the first year. As mentioned earlier, this amount will be adjusted year over year to account for inflation. If they determined in the second year your home's value to increase by the full 2%, then your tax next year would be 1% of $102,000 or $1,020. The second event necessary is the completion of a new construction. Going back to our previous scenario, let's say you chose to build a house rather than buy a house. Again, if your house is valued at $100,000, then your tax would be $1,000. The future inflation calculation would be the same as the previous example, so I'll save you from experiencing that again. But despite this new law being beneficial for everyone in the long run, some found it to be unfair. In 1991, a woman attempted to sue her county in California for a tax refund because she believed her taxes were too high compared to her neighbors. She had recently discovered her neighbors were paying roughly 1/5 the amount she was paying for property comparable to her own. After attempting to challenge the law, claiming it to violate the Equal Protection Clause, the court held that her claim was not in violation, thereby denying her request for a refund. In conclusion, we can see that California's property taxes can be a bit intimidating on the surface, but are manageable after taking just a few minutes to learn how they work. If the property tax portion of California's cost of living intimidates you, don't stress it. You know that property tax consists of real and personal property. You also know that personal property can be both tangible and intangible, meaning you can lick it or not lick it. Who wrote this script? Regarding Proposition 13, just remember that this law benefits you in the long run, so find a place to settle down quickly so you can maximize your benefits. Now, I think it's time you go text your friend and tell her you've got everything covered.